Katie, thank you so much for joining us here at SuperReturn International.
Thank you for having me. It's a pleasure to be here.
It's great to have you here. 5,000 of the industry here gathered, obviously wanting to sort of hear insights and share ideas. You've got a very strong view on management at the moment, active management, and what the best companies are doing around that. Describe that for me and what you look for.
Sure. So just by way of background, I'm the president and CEO of TCW, a global asset manager. And for context, we manage $200 billion of assets for individuals and institutions. And we do that across private credit, and public equity. Of course, here at this conference, we're talking about our alternative credit capabilities, which include CLOs, asset-backed finance, and then within private credit, direct lending and rescue lending. And so when I've talked about active management, I'm really making that comment from the perspective of private credit. And the reason I've been talking about that is that 95% of managers in private credit actually launched post-GFC. We're very unique in that we've been doing this almost for a quarter century, but most of the entrants are new. And the reason that matters is that we've had a pretty benign lending environment for most of the last 15 years, and that is just starting to change. Against a backdrop of a benign lending environment, compression of manager returns has been very tight, and it is our strong expectation that you're going to see much larger dispersion of returns amongst private credit managers going forward, as there are certain tough vintages that have been behind us, and the lending environment becomes more difficult going forward. So we do expect high dispersion of returns amongst private credit managers, and we think credit manager selection is going to be very critical.
Tell me about that. I mean, if manager selection is absolutely critical, what's important in that?
And that's, we've been spending a lot of time with the audience here today on this very issue because, of course, there's a lot of asset owners here and trying to help them think through, like, what are the questions and what are the things that you should be looking for in your manager, certainly in private credit, and asking about. I think there's three key things to focus on right now in hiring managers. The first one we already talked about, but is experience. So longer track records are obviously better than shorter track records. And what that means, if you've been investing like a quarter century, you've stayed in business for 25 years, that means that you've gone through multiple cycles, right? So we've invested through the dot-com bubble, we've invested through the post 9/11 economy, we've invested through the global financial crisis, we've invested through COVID, we've invested through rates backing up from 0 to 5%. That has given us a lot of different cycles to invest through, and I think that's really important, particularly in an asset class that is young. And over that 25-year period, we've had 6 losses. So I would push our managers on that. Are you experienced? What type of experience? Have you invested in different rate environments? How have you navigated that? Have you had to work out situations? How have you worked them out? That all is under the category of experience. Ideally, hiring someone that's actually made some mistakes is good because we've all made mistakes, and what did you learn from them? That's all very important. The second is around discipline. And I think the asset class actually has lost a lot of discipline. And what I mean by that is that there was just a lot of money coming into the asset class, and some people really favored deployment over discipline, just making loans and getting money out. And that's going to start to rear its ugly head now, obviously, in the form of defaults. And you really want to say to your manager, has discipline been consistent, or maybe has the market environment determined what your discipline is, which you don't want. You want someone that's exercised consistent discipline. And there's lots of ways I could express how we do that at TCW Private Credit, but I'll just give you one stat, which is that we stay very disciplined in the way that we look at debt of companies. So we really are 3 to 4 times levered is the max for us for the last 25 years. The last time the market was at 4 and below was in 2012. So people have gone very up in terms of backing larger companies and also doing it with higher leverage, and we think that will eventually present problems in the market. And the last thing is that you want to have some diversification in your portfolio. And so really trying to understand the individual loans that managers are making, and that by adding another manager, you're getting a diversified credit. Because actually, if you have a manager already doing large cap sponsor finance, many people are in the same loans. That's not going to help you to add another manager with the same loan. So you want a diversified credit. And what we've been focused on in terms of diversification is that we've stayed middle market, which is less crowded, and we've been able to command a complexity premium because of the types of loans that we're doing in the middle market. We have stayed sponsor agnostic, so sometimes we do sponsor loans, sometimes we don't. It's 50-50, that's a bit random, but the point is we'll do both. 85% of the market's sponsor driven. So being with someone that's non-sponsor sponsor, by definition, you're getting more diversification. And then finally, we have good sector diversification. So while healthcare and tech was very hot, we're not going to be lenders to that because we want to be liquidity providers. We want to be active when others aren't. We want to be active in sectors that others aren't in. And so we stay sector agnostic and tend to be more involved in less popular things. So those are the three things I would push people on that I think really differentiate us and people should look at for their managers is experience. What's your experience? What's your discipline? And also, how do you add diversification to my portfolio?
You've also talked about the changing relationship between asset managers and banks.
Yeah. So we have announced our own partnership, which I'll come on to in a minute, but just taking a step back, particularly in a US construct, I want to start very big picture and say that let's all agree that we need credit to drive GDP, right? And we all like GDP. This is true. There's really only two ways to get credit into the system. One is through the banks, and the other is through the investment community. And very simply put, during the financial crisis and post-financial crisis, we regulated banks, which means that they have less lending capacity, just putting it very simple. And so we've kind of ended up, and it wasn't necessarily the intention of the regulations, but they did end up really driving growth in private credit. And we've ended up in a place where one might argue banks are long origination capability because no one can originate like a middle market US bank. They have a tremendous number of clients and loan officers to come up with great origination ideas, but they might be short lending capital because of regulations. And on the other hand, you have private credit managers who may originate, but they're always looking for more origination. And they are short, arguably, in parts of origination, and they're long lending. And that's really what's bringing banks and private credit managers together. We announced our own partnership with PNC, which we're very proud to do. Well known in the US. Our European clients maybe and prospects may be less familiar with PNC. It's a leading financial institution. It's the 6th largest bank in the US, and it's the number 4 middle market lender. Incredible management team, pristine balance sheet, so great partner for us. We've actually partnered with them for 15 years. So we've already done 40 co-financings with them, and they're our lead provider of fund finance, meaning they've already due diligenced us as a manager. So that created the foundation for our partnership with PNC. And I'll just end by saying, while a number of these partnerships have been announced, I think this one's very unique for 3 main reasons. The first is that we are, again, going to be really focused only on middle market, where other ones were larger. We're doing 15 to 75 million EBITDA companies. The second is that we're both committing meaningful capital into this partnership, meaning our interests are aligned between PNC, the bank, and TCW, and also with the client. Because if you're not both committing capital, your clients would say, well, are you getting the best origination? But in this case, we both have economics at risk. And then finally, we have a shared credit culture, very conservative underwriting, as I pointed out earlier, and so we've both contributed talent. Rick Miller, our very talented head of private credit, is the CIO and ultimate decision maker of this partnership, but we both actually put people in. So it's a partnership in its truest sense, highly differentiated from others that have been announced, and we're really excited about our ability to help this scale our direct lending business here in Europe and also in the US.
So success around finding cycle-tested, good managers, those great partnerships you've described there. What key trends and sectors do you think that we're going to be seeing interest in? Is there something that you're excited about going forward with all of that good base behind you?
I think, as I mentioned at the outset, we do think the environment's going to be trickier here. And whether we get a recession or not, either way, we're getting into a more complicated environment, which is good for us and the type of high diligent, covenant-heavy lending that we do. And so my answer to you would be, we are excited about this environment for the type of lending that we do. And I do think that it's a very interesting environment for rescue lending in particular, which is a little further out on the risk spectrum of direct lending. But this environment, I don't know when we're going to get a recession. Obviously, eventually we'll get one because that's how the world works, but I can't tell you when that's going to happen. But either way, either we get this soft landing scenario, in which case rates are going to stay somewhat elevated, certainly not at zero like they were for a lot of the last 15 years. And that is going to be a great environment for direct lending and also for rescue. or we're going to get a recession and that will even create more opportunities for that environment. And where else would you rather be in a recession than top of the capital structure, whether you're doing direct lending or rescue loans? So regardless of how the macro environment works, we think it will be good for private credit, the type of lending that we do. And we're particularly excited about rescue because we have a lot of companies out there right now that are good companies and they just have a math problem. They have a liquidity problem. Capital structures were put in place with the expectation that rates were going to stay zero forever, and surprise, surprise, that hasn't happened. The math has taken over, and so we get an opportunity to go in there and be a real solutions provider to companies. And we obviously these are done in a very bespoke way, company by company. We think this asset class can return in the high teens. So you're getting equity-like returns that are contractual. And if you agree with us that rates are going to stay elevated, that we are going to have a problem around defaults and continued stress in these corporates, then this is an incredible way to take advantage of that.
What other key challenges, just finally, do you see on the horizon? Because there are obviously big geopolitical potential shifts this year. We've got lots of elections all around the world. Something like half the population of the world are voting this year. And we're also seeing perhaps a change in demographics as well. What do you think will be other key things that you'll be keeping an eye on in the next sort of couple of years?
If you ask me the thing from this asset class that I think is underappreciated, it's the fact that defaults are going to go up, actually. And in the first quarter of private credit, despite, as I've said, it's become a more challenging environment with elevated rates, defaults went down. Now, why is that? That's kind of unusual. Why would that happen? That happened because last year we had 3 to 4 times the number of amendments that we usually have, which is something you can do uniquely in private credit with small groups of people making those loans and outside the scrutiny of public markets. But some of those are just delayed defaults because you can't amend and pretend forever. And so we expect the default cycle to pick up, and we're, obviously we don't think we're going to be exposed to that because of the way that we underwrite, and we're going to take advantage of it through our rescue strategy. And then the last thing I think has started to come through in the recent news flow that I think is going to get a lot more focus is the fact that a lot of this industry went covenant light. Or didn't have covenants over the last few years. And there was just a big news story this week on a company that everybody sounded very surprised about, where there was a loan to this technology-oriented company, and the company itself found a loophole in the loan documents and moved their collateral remote to the lenders. I thought it was a well-researched and article and interesting and well-written and all that, but it should not be surprising to people. If there are loopholes in loan documents and people don't have covenants, the management teams are going to take advantage of that for their own survival. So I just think it's interesting that people express surprise around that. We should expect that to continue to pick up. And I think what we're all going to remember again is that the covenants are actually the asset class in private credit. It is unique. It is the ultimate hedge, and it doesn't exist in any other asset class. And I think some people gave that away for free, and that's going to turn out not to have been a good thing. And so I really believe that's going to dominate the story. And I'm hoping to end this conversation, I would say TCW private credit will differentiate itself because we've stayed so covenant heavy and have always had covenants and avoided loopholes and underwritten very strictly. And that will differentiate ourselves, to your original question around manager selection. And then we're going to be able to go in and take advantage of some of the dislocation happening in the industry through our rescue capability.
That does indeed bring us full circle.
Yeah.
You've got to have those right teams and managers in there to cope with all of what you just talked about.
Yeah. Well, thank you very much for the opportunity to be here, and great conversation.
Thanks for sharing your insights. Great to see you.